Hello everybody, a happy Friday, happy to have you join us. Welcome to the Like Totas channel, and here we are for yet another day of selling. I'm right now, I'm recording this on the 27th of March. It's quarter to four London time, and the markets continue to bleed, and the Nasdaq is down almost 1.50%, right? So it appears that the sell-off is going to persist well into the weekend, and keep a close eye on oil, everyone, because oil continues to move up. And something that we hadn't seen up until now was the magnificent seven. Well, not up until now, up until recently, was the magnificent seven stocks bleeding in conjunction with the broader market, and that is precisely what we are seeing right now. And because this is one of the most concentrated markets in history, on top of being one of the most pricey markets in history, then it stands to reason that the broader indexes are going to continue to go lower if these large cap names are continue to bleed, and that's precisely what we are witnessing right now. If you find this video insightful, please make sure that you smash the like video, because it really helps the channel to grow, and hopefully we will help more people doing the right thing, and that means buying high quality companies with a margin of safety. Because guys, even though the Nasdaq is down less than 10% from its all-time highs, many of its constituents are down 70 and 80%. And if you guys have been chasing FOMO, right? So if you guys have been following the last trade that you read on social media without doing your due diligence and buying companies at PEs above 50 and 60, you will probably never make your money back. And that is the point that I'm trying to make with this channel and with each and every single episode that I put out. Yes, the market will rebound eventually, but maybe some of those companies will never gonna go back to those levels, because those valuation premiums are just, you cannot justify those valuations. The companies would have to grow their earnings and free cash flows by staggering growth rates, right? Which in and of itself does not have in which case you won't be pricing in any kind of recession or headwind into the next 5 or 10 years, and that in my world is just not sound investing. Okay, so hopefully you have been, if you've been following the channel for a while, so that I managed to stop you from chasing hype and just following companies that generate lots of free cash flows, but that companies that are still trading below what we believe to be their intrinsic value with a big margin of safety. And that, ladies and gentlemen, is the recipe for long-term sustainable investments. Okay, so let's discuss today's video. We are seeing the Mag 7 stocks bleeding, and this hasn't always been the case. Many times I've put out research. Every investment decision that we make at Like a Tortoise is based on research, right? That is the point of following a fundamental approach to long-term investing. And you can see that, for example, right here, you can see that some of hedge funds' main holdings include the largest cap names, right? Companies that everybody owns. Why am I not surprised? Look at this. The most held stocks by hedge funds, as you can see, starting with Microsoft, which by the way is down almost 40% from its all-time highs, Amazon, Alphabet, Alpha, Meta, Nvidia. I promise you this, guys, if these companies continue to sell off, you're going to see a lot of selling pressure in the markets in the weeks ahead, because again, we haven't seen these concentration levels in many decades. Okay, so that's one thing. Everything chasing, piling into the same names. And then what else do we have? You can see that these are periods of extreme concentration, as I was alluding to. Look at that. Since this is 2023, you can see that we had the highest concentration levels since 1932. And we are still pretty much at that level. right? So very only a few handful of companies are driving the vast majority of the S&P 500 returns. Look at this. This is from 2024, as you can see. Top 10 stocks of the S&P 500 market cap hits 38% in June 2024, doubling since 2010 2014. This is staggering. So yes, I mean, I understand they are also the companies that generate the most profits, but what will happen when that stops being the case? And that's what you have to ask yourself. I mean, it's incredible. And what this tells me is that surely many of you guys you haven't been around for a long time in my opinion, because or you are not looking at history. People say, oh my god, I mean, I can't believe it. So but the S&P typically goes up. Yes guys, but there are periods of time, as I've already discussed at length here as well. Let me go back right here. Wait, maybe this is the place. Yes, there are periods of time, but where is that? Right here, where the S&P did nothing, right? Nothing. We are so used to the overall indices moving up, right? That we forgot that we end up falling into recency bias, and we forget to look back and see what happened through many cycles in history. And you can see that there were periods of time, multi-year periods, by the way, where you had to wait 25, 18, 9, 17, 12, 12 years to break even. Right now, markets have been going up ever since 2008. This has been the most prolonged bull market in history. It makes sense that at some point we will see a market crash. Is this the crash that I'm referring to? Is a crash brewing? I have no idea. It doesn't affect my investment decisions, as you all know. If anything, it makes me very exciting because I never chase the shiny objects. I only buy companies with a big margin of safety. So whenever I see people talking about, oh my God, Microsoft this and Microsoft that, and Eli Lilly this, and Eli Lilly that, I know right off the bat those companies don't meet. They just will never have a place in my portfolio. Okay, certainly not at those levels, because I know everybody else is piling into them. Not what I do right here. So if you are looking for that, this is not the channel for you. Okay, so other stuff that I want to show you. Look at this. This is insane. A divided US market, as you can see. Tech companies with no revenues or profits are flying, as are the Mag 7. The rest are left in the shade. And this ties into what I've been saying about quality investing, being underperforming the most on a relative basis since 2000, so the peak of the tech bubble, right? So we are seeing quality companies underperforming, while companies that don't even generate any revenues, let alone profits, exploding higher. This is not sustainable. Sooner or later, this thing is going to come down, and investors who have been building their portfolios around these names without any regard for what they hold or what the valuations those businesses are trading at, they will get smoked. Okay, that's just the reality. The market so in the long term, the market is a weighing machine. In the short term, the market is a voting machine. That's how it works. So you can see this right here, right? Momentum stocks massively underperformed since half of 2023. This has continued to be the case. Is this going to change? I have no idea. But again, what I'm seeing right now with the markets coming down heavily is that many companies, many of its constituents are significantly, well, let's just say that they are attractively priced. And many of them have already big margin of safeties. In fact, I had a call with a client this morning, and you can see that we have been busy building out his watch list of companies The red things that you have right here are companies that, in our opinion, are already ready for him to start investing, because these are the companies that meet his criteria in terms of quality, meaning moat and margin of safety. Make sure that you always do your own due diligence as well. And by the way, don't take any of this as financial advice. That's not the goal. The goal is to provide financial education, to keep you in the loop and tell you exactly what we are doing with our money, because that's important as well. Okay, skin in the game, everyone. Right. So let's show you some of these cool charts. And by the way, look what oil is doing. Guys, I mean, until we find a resolution to this conflict, this is going to be tough, because oil is not moving in tandem with the overall market, in case you haven't noticed yet. So it's actually, so as oil moves up, stocks decline, and the other way around. And there is a reason for that. The longer oil continues, so the longer oil holds at these levels, the more upward pressure there will be on inflation, right? So this means that inflation will remain sticky at higher levels, and then the Federal Reserve, and not just in the America, right, the Federal Reserve, but also central banks across the world, will have a very hard time cutting interest rates into a market that is overheated. Okay, and that's precisely what we risk happening. And in that case, we will have stagflation, so which is sluggish growth coupled with higher inflation rates. Okay, so as oil continues to move up, as I mentioned, and so it stands to reason that stocks will continue to go lower, because ultimately higher inflation will mean lower profitability for many of these companies. In fact, the only pockets of the market that have been performing well are the energy related businesses, because, well, it makes sense, right? With all that 96, if your business, so if you what you sell is a commodity, it makes sense for those businesses then to be very profitable during these times. That said, I mean, I stay away from highly cyclical companies, because as soon as oil comes crashing down, and look, just as fast as this thing is going up, this thing is going to come crashing down, right? It's being driven by fear that is not sustainable, and especially against the backdrop of a weakening economy. And this can come down very sharply, and then all those companies that are tied to the energy and the oil space, they are going to get clobbered. Okay, so never chase the shiny objects. Look for opportunities in sectors of the market that are still underperforming, and I've already mentioned that to members of our community. You have, for example, healthcare. Right here, take a look at this. Healthcare continues to underperform massively relative to the overall market. Many of these companies have been well-performing companies ever since they IPO'd. So if you have an edge here, this is your opportunity to dig deeper into this sector and find investment opportunities. Likewise, you saw, for example, software names getting pummeled, and I'm pretty sure that many of those first of all, the software space is due for a rebound. Once that rebound happens, you're going to see staggering returns. Now, look, whether or not those returns will be sustainable remains to be seen, because I believe that many of these AR fears make sense. And now, granted, we are seeing indiscriminate selling across the board, but many of these software companies, are going to go under. I have no doubt about that. Why? Because AI is just making their service obsolete. But many companies with strong moats will definitely thrive at the end of this crisis. And there is opportunity there for sure, but make sure you always understand the moat of those companies. Okay? In addition, also something that I brought to the attention of our members as well, you can see that this is, so right now you can see that this is fund managers, right? So fund managers were underweight consumer discretionary. This is the lowest allocation since December 2022. There is a lot of opportunities in the consumer discretionary space right now as of this video. This sector is getting pummeled on the heels of a weakening consumer sentiment. And you guys know that it makes sense, right? If consumer sentiment is down, what happens is typically, well, I mean, they are feeling the heat of inflation, so they are curtailing spending, and any discretionary items will be, so they will stop spending on discretionary items. And so all those companies related to apparel in luxury businesses, it makes sense for them to take a breathe, okay? And many of them are not just taking a breather, they are actually collapsing big time. Take a look at what happened, for example, with LVMH. LVMH, which is a company that I own as well. Look at that. I bought this company right here around 426. It experienced a massive rally, but then what they are seeing is, so they generate most of their revenues in the US and China. Yes, they got hit by tariffs, but they are saying that consumer sentiment is weakening. So, right? So their margins are under pressure. That is the phase of the cycle that we are in. This is not going to persist forever, and these companies with strong moats are actually going to do something cool, which is consolidation. In other words, the largest companies in this space will act. And by the way, LVMH is a serial acquirer as well, and one of the best serial acquirers in the world. They have built an empire over decades, and I think as if the sell-off persists in this sector, they will use some of the cash flows, yeah, to acquire these companies outright, which is pretty cool. So we will be seeing some consolidation. That is the power of investing in the best companies in their respective industries. Okay, awesome. So going to the charts right now to discuss the Magnificent Seven, look at the sell-off accelerating, right? Look at all these red. Absolutely insane. Okay, absolutely insane. Let's have a look at Meta. Oh my God, Meta is getting absolutely pummeled. Look at that. This week alone, this stock is down 10%. Yesterday it was down 8%. Today is down another 3.35%. And this company is already down 34% from its all-time highs. So those of you who said, "Oh, these companies are so strong, they will never go back down." Some people that I coach were even saying, "Oh my God, but look, do you ever think Meta is going to go back down to that blue line?" Yeah, because again, if you follow the channel, then you know that no matter how great the company is, everybody, every single company, no matter how good they are, how great the financials are, how great the management teams are, they will go through periods of uncertainty. So you have to be patient. You have to be patient, everyone. So yes, and that's exactly what we saw right here not long ago when Meta crashed 71%, even though there was nothing wrong with its business. These are the kind of opportunities that we are eyeing. Anyway, the stock is down 10% this week. It continues to bleed. So let's see what's going to happen. In addition, take a look at another Wall Street darling, another company that will never go down. And that is, let's have a look at Microsoft. Look at that. It will never go to that blue line. Oh yeah? Take a look at this. Now we are at 360 and the stock is down, what? 36% from its all-time highs. Okay, so if you bought Meta around these levels right here because you believed it will continue to go up, what that tells me is that you didn't know, you FOMO'd into this stock, or you were too exuberant in your valuation assumptions. Okay, and now you are hoping and praying that you break even. And for Microsoft to go back to that level, it would need to justify a higher multiple. Now, look, if there is a company that I think will be able to do that, is Microsoft. They are a phenomenal business, but price is what you pay and value is what you get. At those levels, you had no margin of safety. Okay, that is the point here. Right now, it's becoming more attractive with the P of 23. Still not in my not I'm keeping a close eye on it. Of course, it's a phenomenal business, but and so if you guys own Microsoft shares, then please consider selling so I can consider buying on the other side. Okay, so what else do we have right here? Let's continue. Let's continue. Let's continue. Right, Amazon, another one. So Amazon is down. Let's have a look right here. This company is only down 21%, which is nothing for a company the size of Amazon, which has also attracted so many investment over the last few years. However, when this company goes through volatility, they can quickly flush out, and you can see a big decline right here, as we saw not that long ago, right here in 2022, when the stock crashed 57%. And what were many people doing at $80 a share? Were they buying Amazon? No, because they were puking in the hole like everybody else does, right? But then when the stock was right here at 230, they were buying the stock hand over fist. And that's always what's going to happen when you don't have a framework, you don't have a strategy. Okay, let's continue. Let's see what Google is doing. Another darling. A few years ago, everybody was dismissing, was everybody was writing off this business, and then what happened was staggering. That said, uh, anything that goes through the roof at some point is going to come back down, and it's not going to come. It's not going to take the stairs. It's going to take the escalator. In fact, it's not even going to take the escalator. It's going to jump out the window. And so, from the all-time highs, Google is now down 21%, and the flush continues. I still think there is more downside on these names right here. And again, if that continues, you will see the Nasdaq and the S&P under significant pressure. Okay, so magnificent. Let's look at Nvidia, another company that, in my opinion, has been holding up pretty well. So from its highs, it's only down about 20%. This is nothing, given the volatility that we see in this stock at times. Let's have a look at another darling, Palantir. What is this company doing? Palantir. Okay, so we have Palantir right here. This is down how much? Okay, so this is down 32%. I mean, this is nothing. But eventually, if the sell-off persists, it will drag down even the best performing companies, and that's it. Not to mention all these things, right? I mean, cryptos and all of this nonsense. I mean, you can see right here, for example, crypto. So Bitcoin is now it hit this level of support, but this thing is on the verge of collapse in the yeah. Anyway, I mean, we are seeing the point that I'm trying to make is that when the markets flush, you see it's down sentiment across the board, right? And it makes sense for the most speculative place to actually sell off first. So, guys, this is a time. This is exactly what I wanted to happen. It makes me so happy because number one, I know what I own. Number two, I don't use leverage. So if you are using leverage, you are getting margin calls. And if you are getting margin calls, you're going to blow up your account. And that's precisely the kind of mistakes that I made at the beginning of my own journey. And that's how you can easily blow up a 20K, 10K, whatever account. Okay. It's nasty, but we always have to learn. And that's the way it is. So I mean, I think I'm going to be busy, very busy, adding and starting positions over the next few weeks if this thing persists. I'm very vigilant, and again, yeah, I mean, it's just what it is. Let's see what's going to happen. Keep a close eye on oil. It appears we're going to close. Can we imagine us closing above $100 a share? I mean, the longer this thing continues at these levels, the weaker the economy is going to get. Okay, it's just I mean, everything is so expensive these days. It's hard to believe that inflation is only at 3 or 4%. It's crazy. But anyway, guys, if you like this video, please smash the like button. It really helps the channel. And yes, stay tuned for more. Have a lovely weekend. Don't forget that tomorrow, the 28th of March, we have our live call where you guys can ask me anything. Let's go, everybody. Let's be a tortoise.